The Bank of England sits at the heart of global finance. Textbooks describe it as an institution of monetary stability. Central bankers invoke its 330-year history as proof of institutional wisdom. But the Bank of England was not created for stability. It was created for war. A desperate king needed cash to fight France. Traditional lenders had refused him. So in 1694, a Scottish merchant proposed something unprecedented. Private investors would lend money to the crown. In exchange, they would receive the right to issue paper currency backed by government promises. This was not economic policy. This was a deal. And the terms of this deal still govern how money works today. The founders of the Bank of England did not care about monetary theory. They cared about leverage. They understood a fundamental principle. Whoever controls the flow of money to governments controls the government itself. The bank became a bottleneck. Every major expenditure, every war, every public project would pass through its machinery. This was not about accumulating wealth. This was about occupying a position no one else occupied. The bank's shareholders did not need to own land or command armies. They became the gatekeepers of sovereign credit. They built infrastructure so essential to state function, the state would never dare touch them. The Crown did not grant them a favor. The Crown handed them a permanent revenue stream extracted from the entire nation. Welcome to Noob Historian. Behind every headline in your history book, there's a ledger they kept hidden. We open it. You live inside this system today. When the Bank of England purchased $450 billion in government bonds during COVID-19, it was doing exactly what it did in 1694. It was creating money to finance government spending. When the Federal Reserve buys Treasury securities, it follows a template written 3 centuries ago in London. The mortgage rate on your house, the interest on your savings, the value of the currency in your pocket. All of these trace back to institutions modeled on a war financing scheme designed by merchants looking for profit and a king looking for soldiers. This is not ancient history. This is the operating system running beneath your economic life. The year is 1688. William of Orange has crossed the English Channel with 15,000 soldiers and 4,000 horses. He has come to take the throne from his father-in-law, King James II. The invasion succeeds. James flees to France. Parliament declares William and his wife Mary the new monarchs of England. But William of Orange did not cross the Channel because he cared about English religious politics or parliamentary rights. He crossed because he needed England's resources for a much larger fight. Louis XIV of France was the most dangerous man in Europe. The Sun King commanded the largest army on the continent. He had invaded the Spanish Netherlands. He threatened the Dutch Republic. And now he sheltered James II, recognizing him as the legitimate King of England. William had spent his entire adult life fighting Louis XIV. He had defended the Dutch Republic through decades of French aggression. Now he controlled England, Scotland, and Ireland. He intended to throw all of these resources against France. The 9 Years' War began in 1689. England joined a grand alliance with the Dutch Republic, Spain, the Holy Roman Empire, and various German states. The goal was simple: contain France, reverse Louis XIV's conquests, protect Protestant Europe. The problem was money. Wars in the late 17th century had become extraordinarily expensive. Gone were the days of feudal levies and seasonal campaigns. Modern warfare required standing armies. Professional soldiers needed regular pay. Artillery required massive investment in bronze and iron. Navies consumed entire forests for ship timber and demanded permanent dockyards. The 9 Years' War would cost England approximately $5.5 million per year at its peak. The entire annual revenue of the English crown at the time was around $2 million. William faced a financing gap of $3.5 million per year, every year, for as long as the war lasted. Traditional options had failed. At last, the crown tried to raise taxes. Parliament resisted. English landowners did not want to pay for a war they saw as primarily Dutch in motivation. The land tax generated revenue, but never enough. Excise duties on goods hit the poor and generated political opposition. The crown tried to borrow directly. Short-term loans from London merchants carried interest rates of 10 to 14%. These rates were ruinous. Worse, lenders demanded repayment within months or a few years. The crown found itself trapped in a cycle of rolling over expensive short-term debt while fighting a long-term war. The crown tried lottery loans and tontines. These were complex financial instruments designed to raise capital from the public. They generated some funds, but not nearly enough. Administrative costs ate into proceeds. Public enthusiasm faded after the first few offerings. By 1694, the situation had become desperate. The war was going poorly. The French Navy had destroyed an English convoy at Lagos. A French invasion fleet had been stopped at La Hogue, but at enormous cost. English forces on the continent achieved little, and the bills kept coming. William III needed a new solution. He needed someone to lend him large sums at reasonable interest for extended periods. He needed access to money now in exchange for promises to repay later. He needed something England had never possessed: a central bank. The Dutch Republic had the Bank of Amsterdam, founded in 1609. This institution provided stable money and credit facilities, but the Bank of Amsterdam did not lend to the government. It focused on stabilizing currency and facilitating merchant transactions. William needed something different. He needed an institution designed specifically to channel private capital toward government borrowing, an institution where investors would accept government promises as assets, an institution where paper could substitute for gold. A Scottish merchant named William Paterson claimed to have the answer. William Paterson was not a banker by training. He was a trader, a projector, a man of schemes and proposals. Born in Scotland around 1658, Patterson had spent years in the Caribbean and American colonies. He had traded goods across the Atlantic. He understood commerce. He understood the power of credit. And he had watched the Dutch financial system with careful attention. By 1691, Patterson had developed a proposal. He would later describe the core insight in blunt terms. "The bank," he wrote, "hath benefit of interest on all moneys which it creates out of nothing." This was the revolutionary principle. The bank would lend money to the government, but the bank would not need to possess all this money in gold or silver. Instead, the bank would issue paper notes. These notes would circulate as money because people trusted the bank to redeem them, and the government, as promised to repay its debts to the bank, would serve as the asset backing these notes. The bank would create money out of promises. Patterson's proposal took years to gain traction. He pitched it to various officials. He found supporters and skeptics. But by 1694, the government's desperation had reached the point where radical ideas received serious attention. Michael Godfrey, a London merchant with extensive connections, became Patterson's key ally. Godfrey had the social standing and business reputation to make the scheme credible. Together, Patterson and Godfrey assembled a group of wealthy Londoners willing to invest. The final proposal worked like this. Private investors would subscribe a total of $1.2 million. They would lend this entire sum to the Crown immediately. The Crown would pay 8% annual interest on the loan, plus $4,000 per year for management expenses. This totaled $100,000 per year, flowing from the Treasury to the bank's shareholders. In exchange for this loan, the investors would receive a corporate charter. They would become the governor and company of the Bank of England. This corporation would hold special privileges. It would manage the government's debt. It would accept deposits from the public. And most importantly, it would issue paper notes up to the value of its capital. These paper notes were the key to the entire scheme. When the bank issued notes, it was creating circulating currency. Merchants would accept these notes because they trusted the bank. The bank's trustworthiness rested on two foundations. First, it held the government's debt as an asset. Second, it maintained reserves of gold and silver to redeem notes on demand. But the bank did not need to hold gold equal to all the notes it issued. It needed to hold enough gold to meet normal daily redemptions. Experience showed most people would hold the notes rather than redeem them. The bank would issue more notes than it held gold. This was fractional reserve banking. This was the creation of credit money, and it was explicitly designed to finance war. The interest payments flowing to bank shareholders came from taxes. Parliament earmarked specific revenue streams to guarantee payment. Duties on ship tonnage and beer would pay the $100,000 annual charge. This arrangement made the government's promise credible. Investors knew exactly where their interest payments would originate. The bank opened for subscriptions on June 21st, 1694. The entire $1.2 million was subscribed within 12 days. Wealthy merchants, minor aristocrats, and even some foreigners bought shares. They saw an opportunity. They would earn 8% annually on a loan guaranteed by Parliament and backed by specific tax revenues. The shareholders included many of the wealthiest merchants in London. They included members of the East India Company. They included foreign investors with ties to Dutch finance. This was the cream of English commercial society pooling their capital for mutual advantage. The bank received its royal charter on July the 27th, 1694. The governor and company of the Bank of England had come into existence. Within months, the bank had transferred $1.2 million to the Treasury. William III had his war money. The bank had begun issuing notes. A new era in government finance had begun. Not everyone celebrated the bank's creation. The parliamentary debates of 1694 recorded fierce opposition. Many of these critics saw dangers their contemporaries dismissed as paranoid or self-interested. Reading their warnings today produces an uncomfortable sensation. They predicted problems we still face. The Tory opposition in Parliament led the resistance. Country landowners feared the bank would create a new class of moneyed men whose interests would dominate policy. These critics saw a fundamental shift in power away from the traditional landed aristocracy toward London financiers. Charles Davenant, a political economist and one of the most articulate critics, warned about perpetual debt. If the government borrowed to fund current expenses and rolled over the debt indefinitely, the nation would become permanently indebted. Interest payments would consume tax revenues forever. Each generation would inherit the debts of its predecessors without ever paying them off. This prediction proved accurate. The original $1.2 million loan has never been repaid. It has been refinanced, absorbed into larger debt structures, and converted through various financial operations. But in substance, it remains. The British national debt today exceeds $2.5 trillion. The debt has grown in every century since 1694. Other critics worried about foreign influence. Many of the bank's original shareholders were Dutch or had Dutch connections. William III himself was Dutch. These critics saw the bank as a tool of foreign interests, channeling English resources toward continental wars. The xenophobic tone of some complaints should not obscure the underlying concern about accountability. Who would these bankers answer to? Parliament? The Crown? Their own shareholders? The structure created ambiguity about political control of monetary power. Some opposition came from goldsmiths and private bankers who saw the bank as a competitive threat. London's goldsmith bankers had provided financial services to the Crown and to merchants for decades. They issued their own notes. They took deposits. They made loans. Now a privileged corporation would compete with them while enjoying government backing. These competitors understood something important. The bank's special relationship with government gave it advantages no private banker possessed. If the bank ran into trouble, the government would have powerful incentives to rescue it. The bank had become too connected to state finance to fail. This implicit guarantee made the bank safer than competitors, attracting deposits and allowing lower interest rates. The concept of too big to fail existed from the Bank of England's first day. Perhaps the most prescient critics worried about the relationship between money creation and political power. If the bank issued notes backed by government debt and the government borrowed to finance its activities, then the bank and government had entered a symbiotic relationship. The bank needed the government to borrow so it could hold debt as assets and issue notes. The government needed the bank to purchase its debt and supply it with funds. This mutual dependence would shape incentives. The bank would support government borrowing because borrowing expanded bank assets and profits. The government would protect the bank because it needed access to bank credit. Both parties benefited from expanding debt. Critics saw a machinery of perpetual extraction. Taxpayers would pay interest to bank shareholders forever. Every war, every crisis, every expensive project would add to the debt and add to shareholder returns. The national debt would become a mechanism for transferring wealth from the taxed masses to the investing classes. Parliament passed the Tonnage Act of 1694, despite these objections. The war needed funding. William III needed his bank. And the wealthy merchants who would profit from the arrangement had considerable influence in London and Westminster. The opposition had lost, but they had documented their concerns. Their words survive in parliamentary records, pamphlets, and political tracts. 3 centuries of experience have proven many of them correct. The Bank of England opened its doors at Mercer's Hall in London. From the beginning, it operated differently from any previous financial institution in English history. The bank's first challenge was practical. How do you convince people to accept paper notes as money when they have used gold and silver coins for centuries? The answer involved careful management of trust. The bank issued notes in large denominations. The smallest notes were worth $10 or $20, significant sums when a skilled laborer earned perhaps $15 to $20 per year. These notes circulated among merchants and wealthy individuals, people sophisticated enough to understand credit instruments. The bank maintained gold reserves and promised to redeem notes on demand. Anyone holding a banknote could walk into the bank and exchange it for gold or silver coins. This promise of convertibility gave the notes credibility. Initially, the bank operated conservatively. It issued notes cautiously and maintained substantial reserves. It wanted to build reputation before testing the limits of its powers. The bank also offered other services. It discounted bills of exchange, providing merchants with cash today in exchange for payment promises due in the future. It accepted deposits and paid interest. It transferred funds between accounts, allowing merchants to settle debts without moving physical coins. These services made the bank useful to London's commercial community independent of its government financing function. Merchants valued access to reliable financial services. The bank's credibility grew, but the bank also faced early crises revealing the fragility of its position. In 1696, England undertook a massive recoinage. The old silver coins had been clipped and debased over centuries. Their actual silver content fell far below their face value. The government decided to call in the old coins and mint new ones. This created a currency crisis. As old coins were withdrawn, the money supply collapsed. People panicked. They rushed to convert banknotes into gold and silver before both disappeared. The bank faced a run. Depositors and note holders demanded coin. The bank's reserves drained rapidly. For a moment, the bank teetered on the edge of failure. The bank survived by suspending full convertibility temporarily and by arranging emergency support. It issued smaller denomination notes to maintain circulation. It worked with the government to manage the transition. By 1697, the crisis had passed. This episode taught important lessons. Paper money depended on confidence. Confidence was fragile. When everyone tried to convert paper to metal simultaneously, the system broke down. The bank's survival required managing expectations as much as managing reserves. The bank emerged from the Recoinage crisis with its reputation enhanced. It had faced a severe test and survived. People now had evidence the bank would weather storms. This increased willingness to hold banknotes. The bank also learned to cooperate more closely with government. During the crisis, the bank and Treasury had worked together to prevent complete monetary collapse. This cooperation established patterns persisting to this day. The central bank and the Treasury become partners in managing money. By the early 1700s, the bank had established itself as the central pillar of English finance. Its notes circulated widely among merchants. Its services facilitated trade, and its ability to lend to government proved indispensable during ongoing wars. The War of the Spanish Succession began in 1701. Again, England needed massive financing. Again, the bank provided. The national debt expanded from roughly 16 million in 1702 to 54 million by 1714. Each war ratcheted up the debt. Each expansion of debt expanded the bank's role. The bank bought government securities. It issued notes. It provided credit. War fed the bank, and the bank fed war. The Bank of England did not remain unique. Other nations watched, studied, and imitated. The French observed the English experiment with particular interest. France, under Louis XIV, had developed its own financial structures, but these depended heavily on tax farmers, private financiers, who advanced money to the crown in exchange for the right to collect taxes. This system was inefficient and extractive. Tax farmers took enormous commissions. The crown received far less than taxpayers paid, and France lacked the stable credit instruments England now possessed. After Louis XIV died in 1715, French finances lay in ruins. Decades of war had exhausted the Treasury. A new regent sought solutions. John Law, a Scottish gambler and financial theorist, proposed a radical restructuring. Law had studied the Bank of England. He understood credit money, but he wanted to go further. Law established the Banque Générale in France in 1716, later reorganized as the Banque Royale. He combined this bank with a trading company holding monopolies on French colonial commerce. He issued paper money on a massive scale. The scheme collapsed spectacularly in 1720. The Mississippi Bubble, as it became known, discredited paper money in France for generations. The French would not establish a lasting central bank until the Banque de France in 1800. Law's failure carried lessons. He had expanded credit too rapidly. He had not maintained sufficient reserves. He had allowed speculation to drive prices to unsustainable levels. But the underlying principles Law borrowed from England were not wrong. His execution was: Sweden created the Riksbank in 1668, actually predating the Bank of England. But the Riksbank initially operated differently, focusing on exchange operations and deposit banking rather than government financing. Over time, it evolved to take on functions similar to the Bank of England, including lending to the crown and issuing paper currency. The German states developed various banking arrangements, often connected to territorial treasuries. The Bank of Prussia, established in 1765, would become a significant institution in continental finance. Each nation adapted the template to local conditions, but the core elements remained consistent. A privileged institution, close ties to government, the ability to issue paper currency, lending to the sovereign. The United States provides the most interesting case of resistance and eventual adoption. The founding generation of American leaders had studied European finance. They knew about the Bank of England. Many of them distrusted it. Thomas Jefferson saw banks as engines of speculation and corruption. He feared a moneyed aristocracy would dominate Republican government. He opposed Alexander Hamilton's proposal for a Bank of the United States. Hamilton, in contrast, admired the British financial system. He understood how England's ability to borrow cheaply had enabled it to project global power. He wanted America to develop similar capacity. Hamilton won the first round. The first Bank of the United States received a charter in 1791. It was modeled explicitly on the Bank of England. It held government deposits, it issued notes, it lent to the federal government. But American politics remained hostile to centralized banking. The first bank's charter expired in 1811 and was not renewed. A second Bank of the United States operated from 1816 to 1836, before Andrew Jackson killed it by withdrawing federal deposits. For decades, the United States lacked a central bank. The federal government deposited funds in state banks. Currency consisted of notes issued by thousands of different private banks. Financial panics recurred regularly. Only in 1913, after the devastating panic of 1907, did the United States create the Federal Reserve System. The Fed's structure differed from the Bank of England in important ways, with regional banks and divided authority. But the core functions paralleled those established in London in 1694, issuing currency, lending to banks, financing government in emergencies. By the 20th century, every major economy had a central bank: the Bank of Japan, the Deutsche Bundesbank, the Swiss National Bank. The template designed to finance King William's war against France had become universal infrastructure. Return to the founding moment. July 1694, London. A king needs money to fight a war. Merchants see an opportunity. They exchange cash for privileges. A new institution emerges. The participants understood this as a temporary arrangement. The war would end. The debt would be repaid. The bank's special privileges would expire with its founding charter. None of this happened. The 9 Years' War ended in 1697. The debt was not repaid. Instead, the War of the Spanish Succession began in 1701. New borrowing occurred. The bank's charter was renewed and extended. Each crisis produced new debt and new reasons to maintain the bank. This pattern has repeated for 330 years. The French Revolutionary Wars, the Napoleonic Wars, the Crimean War, the Boer War, the First World War, the Second World War, the Cold War, the global financial crisis, COVID-19. Each emergency required new borrowing. Each borrowing added to the debt. Each addition to the debt strengthened the bank's position as manager of government finance. The numbers tell the story. In 1694, the initial bank loan was $1.2 million. By 1750, the national debt exceeded $78 million. By 1815, after the Napoleonic Wars, it exceeded $840 million. By 1900, it was around $635 million, having been paid down during decades of peace. By 1920, after the First World War, it reached $7.8 billion. By 1950, after the Second World War, it reached $25 billion. Today, it exceeds $2.5 trillion. The debt has grown roughly 2,000% since 1694. Interest payments on this debt flow from taxpayers to bondholders every year, century after century. The specific bondholders change. The flow continues. This is what Charles Davenant warned about in 1694. Perpetual debt, permanent extraction, a machinery of wealth transfer encoded into the structure of the state. Modern economists justify this system with theories unavailable to Davenant. Debt can stimulate economies. Government borrowing provides safe assets. Central banks stabilize financial systems. These arguments have merit. The question is not whether central banks provide benefits. The question is whether those benefits require the specific structure created in 1694, whether the entanglement of private profit and public money was inevitable, whether alternatives existed and were suppressed. Consider what the Bank of England did during COVID-19. The British government needed to spend hundreds of billions of pounds supporting the economy and health system. It borrowed this money by issuing bonds. The Bank of England purchased over $450 billion of these bonds. When the bank purchases bonds, it creates new money to do so. It credits the Treasury's account. The Treasury spends this money into the economy. The bank now holds government debt as an asset on its balance sheet. This process carries a name, quantitative easing. It sounds technical, neutral, scientific. But this is exactly what William Patterson proposed in 1694. The bank issues money against government promises to repay. The government gains purchasing power now. Future taxpayers bear the burden of interest payments later. The mechanism persists because it serves those who control it. Government officials gain access to funds they would otherwise need to raise through taxation. Taxation is politically painful. Borrowing is politically convenient. Bondholders gain access to safe, interest-bearing assets guaranteed by the taxing power of the state. They receive income extracted from the entire population. The bank itself gains relevance, power, and resources. Its balance sheet grows. Its influence over economic policy expands. Its position as essential infrastructure becomes unassailable. This is not conspiracy. This is structure. The incentives embedded in the 1694 design produce predictable outcomes. Debt grows. The bank's role expands. The partnership between financial institutions and government deepens. You participate in the system whether you understand it or not. When you earn wages, you pay taxes. A portion of those taxes services the national debt. A portion pays interest to bondholders. Your labor feeds the machinery. When you save money in a bank account, your deposits become raw material for credit creation. The bank lends against your deposits. Money multiplies. The system expands. When you borrow for a house or a car, you take on obligations enforced by the same legal and financial infrastructure. Interest payments flow through networks connecting ultimately to central banks. This is not oppression in any simple sense. You receive benefits from the system, monetary stability most of the time, access to credit, a functioning payment system. But you did not design this system. You did not vote for its fundamental structure. It was imposed centuries before your birth and will persist centuries after your death. The founders of the Bank of England solved their immediate problem. William III got his war money. The merchant investors got their privileges. England defeated Louis XIII, but they also created something none of them fully understood. A template for organizing the relationship between money, government, and private power. A template so successful it has been adopted by every nation on earth. The permanent emergency has never ended. The original crisis was a war against France in 1694. Today, the crisis is a pandemic. Tomorrow, it will be climate change. Next year, it will be something else. Each crisis justifies expansion of government borrowing. Each expansion of government borrowing flows through central bank machinery. Each iteration entrenches the system further. Understanding this history will not free you from the system, but it will let you see the system clearly. You will recognize the interests shaping monetary policy. You will understand why governments borrow rather than tax. You will trace the genealogy of your mortgage rate and your savings return. The Bank of England sits in London today. It occupies a building on Threadneedle Street. Its officials speak in measured tones about inflation targets and interest rate adjustments. They are the descendants of William Patterson's scheme. They are the administrators of an apparatus created to finance a 17th century war. They manage the permanent debt. They operate the machinery of credit money. And the ledger they keep has never been closed. End of script.